Hey, I'm Martin Bamford, and I know that investing can be hard. There are so many conflicting pieces of advice out there, it's hard to know what's worth listening to. This video will show you the red flags that accompanied one piece of investment advice, resulting in a couple losing more than half of their investment. They should have spotted one big red flag in particular, their financial advisor following them in his car to their bank 3 miles away to make sure they invested the recommended amount. That wasn't the only red flag they missed. What does good financial advice look like? It's an important question because all too often in the press we're faced with examples of pretty shocking bad financial advice, and I was in two minds about making this video following an article that appeared in the Times yesterday about what on the face of it at least looks like some fairly terrible financial advice. But after sleeping on it last night, I decided it was important to make this video because there are multiple lessons here that I think we can learn. I think they can serve as an example of where advice goes badly wrong, and also what to look for when looking for a good financial advisor. Now, before I dive into this one, I want to caveat it that I'm working solely off this press report. It's an article written by Ali Hussein for The Times, and I'll share a link to that article in the description if you want to read it in full. I'm also going to say that I'm not the type of financial advisor that likes to attack others or criticize others for their actions. The report in this article isn't necessarily representative of business practices at the financial advisory firm in question, and it may also just be an isolated case, an isolated individual acting inappropriately. But as I said, I think there are some good learning points within this article that we can take a look at together, and hopefully this will help people in the future not to get to the stage that this retired couple have reached in this particular story. So for some context then, the article opens by explaining that a retired couple have complained to the investment giants SJP, St James's Place, about a financial advisor who went into a bank branch with them to ensure they invested in a high-risk scheme that lost them £158,000. He goes into more detail about each of these elements, but just starting with the issues, I guess, in the opening paragraph. If a financial advisor accompanies you to a bank branch to make sure that you transfer money correctly or move money into a particular investment scheme, that to me is a massive red flag. I don't know the circumstances in this particular case and why the financial advisor in question decided it was appropriate to accompany this couple to the bank branch, but it's a red flag if somebody goes with you to make sure you move money in a particular way. And I really do have to question where the bank branch staff were on that particular occasion. If somebody walks into a bank and they were accompanied by a scruffy looking builder, I suspect the bank branch staff would be all over that particular transaction, trying to make sure that the customer's not being taken advantage of and that a scam or a fraud wasn't taking place. But because they're accompanied by someone who I assume was dressed in a suit and tie, I wonder if the bar was just a little bit lower and fewer checks were carried out than probably should have been. The opening paragraph also explains that they invested in a high-risk scheme and lost £158,000. We do have to keep in mind here that investments do carry the risk of capital loss. There are no guarantees with an investment that you will either make money or not lose money. And that's why we see these risk warnings all over the place all the time, that the value of investments can go down as well as up. And it's essential we don't ignore those risk warnings and we don't assume that they won't apply to us, particularly because of the experience we've had with the investment markets in recent years, particularly the last 12 months or so after that big dip last March at the onset of the pandemic. We've seen really quite strong equity market growth globally in the past year, and that isn't necessarily a normal scenario. We shouldn't expect that all the time. The gains we've seen in the past year or so, in fact over the past 5 or 6 years, these are not normal gains in the sense that they're not guaranteed to continue forever. As I said, in fact, you can lose money when you invest your money. That's really important to keep in mind. So the article goes on to introduce the couple, who are both in their early 70s, and it says they believe they've lost more than half of the £300,000 they originally invested in what's called an enterprise investment scheme, an EIS. This was recommended back in 2015 by their advisor, their financial advisor at SJP. I'll keep going through the article in just a second, but let's talk first about what an enterprise investment scheme is, just so we understand the terminology and what's involved, some of the risks, some of the benefits. So an EIS is a government-backed investment scheme, and it offers some quite attractive tax relief to investors who buy shares in qualifying companies, typically smaller companies and early stage companies looking for funding so they can grow further. So enterprise investment schemes absolutely are high risk investment schemes, and that's why they've got these tax incentives incentives that come with them to encourage investors to take on those risks. There is an unbreakable link between risk and reward, and I've spoken about that before in previous videos. If you want the potential for higher rewards, higher returns, then you have to be prepared to expose your money to the risk involved. Greater risks of volatility, greater risks of capital loss. And because the underlying businesses in an EIS are at an early stage and they're smaller, they are significantly riskier than well-established businesses, larger businesses in which you might invest. So lots of risks involved, as well as risk to your capital. There's risk that the tax relief and the tax treatment of the investments in the EIS could change. And that's because the underlying companies in which you invest may not maintain their qualifying status over time. There's also a minimum holding period within the EIS. You have to keep shares for at least 3 years in order to hang on to any tax relief that you've claimed. But actually 3 years from an investment perspective, particularly for higher risk, smaller companies, early stage investments, it's a very short period of time. And you may need to hold on to those investments for a much longer period of time, much longer than 3 years, to give them a chance to grow and to realize your investment growth. There are several types of tax relief benefits for investors in an EIS, and this is often what attracts investors who can stomach that amount of risk from an investment perspective. The first is income tax relief. You can claim back up to 30% of the amount of your investment as income tax relief. So, for example, if you invest £10,000, you can claim back £3,000 in income tax relief. There are then a couple of types of capital gains tax relief associated with an EIS investment. The first is called disposal relief, and this says that as long as you hold your shares in the EIS for at least 3 years, any capital gains that you make in the EIS are exempt from capital gains tax when you sell them. And then the other type of capital gains tax relief for the EIS is called deferral relief, and this is where you don't have to pay capital gains tax until a future date, a date in the future, if you use the gain from a previous investment to purchase shares in the qualifying EIS. You only pay the capital gains tax later when you eventually sell the shares. There's some good news for investors who lose money in an EIS, although it probably doesn't feel like good news at the time because you've lost money, but you can claim loss relief. So the loss relief is available at the highest rate of income tax you pay. For example, if you pay the additional rate of income tax at 45%, you can claim 45% of your net loss in the EIS as income tax relief. So let's say you invested £10,000 and the underlying businesses failed and went to zero. You would firstly claim the 30% income tax relief going in, so £3,000 income tax relief when you made that investment. And then you can also claim loss relief on the remaining £7,000, so on the net amount. That's assuming that you've got sufficient income tax paid at that tax bracket. So 45% of £7,000 is £3,150. So really, after all of your tax relief, the only loss you've made is £3,850 because of the income tax relief going in and the loss relief coming out. EIS investments are also exempt from inheritance tax. So there's inheritance tax relief of 100%, but you have to hold the shares for at least 2 years for that to become available. There's a rule with this inheritance tax relief that says you can't claim the relief if the underlying shares are listed on a recognised stock exchange. So this is only for unlisted company investments. But that's broadly how EIS tax relief works. Now, going back to this article in the Times, the recommended EIS invested in several high-risk, smaller stage companies, early stage companies, including those run in renewable energy operations in Italy. It appears from reading this article that the reason the financial advisor recommended they put £300,000 into the EIS was to offset a capital gains tax liability that they had after selling a valuable painting. Back in 2014, they sold a painting by John Lavery that had been inherited, and that sold for £615,000 at an auction at Christie's. It resulted in an estimated CGT liability of about £160,000. The following year, 2015, the financial advisor suggested they invested £300,000 in an EIS with a provider called Octopus in order to defer that capital gains tax liability. And again, it's a deferred liability. It's not a wiped out liability. So that capital gains tax would have to be paid at some point in the future. By reading through this report in the Times, it does appear that one of the main goals for this retired couple was to generate £22,000 a year in tax-free income from this investment scheme. So they would have an income in retirement. However, 6 years after making the investment and shortly before these income payments were due to start from 2019 onwards, all withdrawals from EIS were frozen. So the couple haven't received any income to date. And at the same time, the value of their holdings fell to £142,000. So they lost more than half of the money they invested. I'm scanning through this article and just trying to pick out a few of the key lessons that I think we can learn from this story and a few of the issues as they appear to be in this particular case. One is this requirement for this income of about £20,000 a year to support their lifestyle in retirement. That to me seems like an important financial goal, and whenever we invest money, we always need to start with a purpose in mind. Deferring capital gains tax is a fantastic result if you can achieve it. My accountant always says to me that a tax deferred is a tax saved. Now, ultimately, you have to pay that tax at some point in the future. But if you can put off paying the tax legitimately for a period of many years, then that's a good thing. The risk is that they may ultimately end up paying capital gains tax at a higher rate than they would have done if they'd simply paid the tax following the sale of a painting. It's so important to remember that tax rates and the tax treatment of particular investments can and does change on a fairly regular basis. It only takes a budget or a new piece of legislation, and we could quite easily see capital gains tax rates doubled, as was recommended just last year by the Office for Tax Simplification. So deferring a tax liability like a capital gains tax liability isn't necessarily a tax saving strategy. It just kicks the can up the road a little bit longer. But reading through this report in the Times, it really does seem that the primary financial planning objective for these clients was to start generating an income to supplement their income in retirement. And obviously the capital loss they've experienced is going to hurt, despite getting 30% income tax relief on the way in, despite having their capital gains tax deferred, and despite, I suspect, being able to qualify for some loss relief if they sell this investment at some point. But not receiving the income they expected seems to probably be the biggest issue here. There's also the issue of liquidity. This is an enterprise investment scheme from Octopus Investments, and Octopus have frozen withdrawals. They say that they hope investors can have access to remaining funds in the next few months. But the lesson here is about liquidity, and this is something we're seeing time and time again. When investors put money in smaller companies that aren't particularly actively traded, it doesn't take very much for there to be a liquidity crunch, which restricts access to their money. I think liquidity is one of those risks that's too often overlooked when we invest money. And to ensure that you have access to your money when you need it, you really do need to stick to mainstream investments in fairly large companies that are well traded on recognized stock exchanges. As soon as you go off-piste and as soon as you start looking at early stage companies, smaller companies, alternative assets, you have to recognize that there is a very real risk of a liquidity crunch, which could completely deny you access to your money for a period of time, perhaps forever. There's a lesson explained in this article about the high pressure sales tactics the couple claim were used by the advisor to sell these products. We've already touched on this issue of him insisting on going with them to their bank to make sure the money was transferred properly. Don't let people pressure you into buying things, either in terms of going with you to make sure you do it or giving you a deadline to make that investment, placing you under time pressure. Those are huge red flags. As soon as you feel uncomfortable in any way with an investment or another financial advice recommendation that someone's made, press the pause button for a while. Take some time to think things through properly, maybe to seek a second opinion. Never ever rush into anything. You're not going to miss an investment opportunity because of some make-believe deadline. I spoke before in my video about things to think about before the end of a tax year, which I'll put up here, about how some allowances are use it or lose it allowances that you're not able to carry forward until the next tax year. But really, so what? If the worst thing that happens is that you miss out of 1 year's worth of tax allowances, that really isn't a bad thing if it means you avoid getting into an unsuitable investment. Another big lesson from this article is never let the tax tail wag the investment dog. And what I mean by this is it's great to save tax where you can, where it's legal, so tax avoidance, not tax evasion, but always start with your financial planning goal in mind. Let that drive your investment decisions, not the ability to save a little bit of tax. In this particular scenario, the income tax relief, the capital gains tax deferral, the EIS loss relief, these will soften the blow just a little bit on the money the couple are likely to lose. But tax savings should never be the primary reason for going into any particular investment. As well as not allowing the tax tail to wag the investment dog, you also have to look out for commission. Commission was banned on the sale of retail investment products back at the end of 2012 as part of what we call the Retail Distribution Review. It was replaced with something called advisor charging, where a specific fee or charge had to be agreed between the advisor and the investor before it could be deducted from products and paid to the advisor. It looks a lot like commission, where that happens, and I have to say particularly where the amounts paid are at a high level. The article explains that the advisor was paid £13,500 once this investment was made, and that's an advisor charge which represents 4.5% of the investment of £300,000. Even in the pre-2012 days where commission was paid on products, 4.5% was a large commission. The article also explains that Octopus Investments has received, as a provider, £7,162, which is just under 2.4% of the investment amounts. So some quite high initial charges associated with this investment. And again, that's a red flag. If you're being advised to invest money and so much of that money is being gobbled up in initial charges on day one, you really have to think about the motivation for the recommendation. Whether this incentive of a fee, or a very large fee in this case, being paid was influencing the recommendation being made in any way. This investment recommendation is now subject to a complaint. The couple complained to SJP in February 2020, and that complaint was rejected by SJP just a couple of months later in April 2020. In rejecting the complaint, SJP said the advisor agreed to accompany the couple to the bank to ensure the correct processing of the payment and, if necessary, to answer any questions. He also ensured that the correct tax relief documentation was delivered to the client's accountants. SJP also said that the couple made significant savings to offset their loss. They lost about £158,000, but apparently the different elements of this advice more than offsets the loss, and that's because they deferred £80,000 in capital gains tax from the sale of the painting. They saved £56,000 from inheritance tax mitigation, £17,000 of tax savings on another product that SJP sold, and £10,000 of income tax saving. I would suggest there is a little bit of double counting going on there because, for example, they wouldn't pay capital gains tax if they died and therefore saved inheritance tax. And also a deferral of capital gains tax. It's a deferral. It's not a capital gains tax saving. Because SJP rejected this complaint and the couple were not happy with the outcome of that complaint being rejected, they've now referred the complaint to the Financial Ombudsman Service. The Financial Ombudsman Service is an independent arbitrator of complaints against regulated financial services businesses, and their word is final. So if FOS do rule in favour of the couple, then SJP will have to accept that ruling. I do have some concerns about FOS and their ability to understand more complex advice complaints, as this one does appear to potentially fall into that category. And we also have to keep in mind that FOS has a massive backlog of unresolved complaints, one of the things that triggered the recent resignation of their chief executive. So lots of lessons we can learn, I think, from this article in the Times and this experience from this couple. Hopefully, so people watching this video can avoid making the same mistakes in the future. I don't want people who read articles like this in the Times or other newspapers, or indeed who watch videos like this one, to listen to me talk about the lessons learned and think that this is anyway a typical experience of working with a financial advisor. It really isn't. The money press like to run stories like this because they generate debate. They prompt people like me to make YouTube videos like this about the stories. And me and my peers yesterday were tweeting a lot about this story as well. There's a saying on Fleet Street that if it bleeds, it leads. And I think human nature is we're drawn into negative news stories and horror stories in some cases. But this really is not the typical experience somebody will have when they work with a professional financial advisor, particularly if they work with one who is independent, not restricted like an SJP advisor, but an independent financial advisor, particularly if they work with an advisor who charges a fixed fee for what they do and removes that potential for bias associated with earning something that looks a lot like commission. And the other thing to look out for is to make sure the advisor is properly qualified. I don't know in this particular case the qualification level of the advisor in question, but the things to look out for is that the advisor is at least a chartered financial planner, and therefore they have demonstrated their competency, particularly when it comes to more complex forms of financial planning and tax planning using investment schemes. But really, my message here is to go back to basics before looking at complex high-risk investment schemes. Think about why you're making that investment. What's your motivation for investing money? Make sure you understand the difference between deferring a tax liability and saving tax, and please look out for that liquidity risk because it's something we're seeing more and more of, and it really doesn't take very much for a liquidity crunch to happen and for your access to your investments to be completely taken away from you for a period of time. What did you make of this tale of investment advice gone wrong? Let me know what you think in the comments. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.